In today's video, I'm going to share with you a winning strategy and structure that my buyers are using in 2024. 2024 specific because the market's changed. What you can get from the sellers has changed. So stay tuned. I'm going to get into detail. I'm going to show you examples, as always, the loan structure that's working for my clients. Matt Gouget, Matt the Mortgage Guy, residential mortgage broker, licensed in 48 states. Connect with me and my team, greatmortgagebroker.com. We'd love to help. We'd love to help you put together great loan structures like the one I'm going to talk about in this video that help you win. So without further ado, I want to talk about a loan structure that's not anything new. It's not anything I haven't talked about in the past, but specific to 2024, I see it as a viable option and one of the best options for people that are looking to get into home ownership. First-time home buyers may be utilizing this more than anybody else, but you've heard of the temporary buy downs: 1-0 buy down, 2-1 buy down, 3-2-1 buy down. So that's nothing new. If you haven't heard about the buy down, look at my old videos. It's simply getting credits from the seller to fund a temporary interest rate reduction and lower payment. For example, a 1-0 buy down. In the first year, your interest rate is 1% lower. Therefore, your payment is going to be lower. In that first year, years 2 through 30, the rest of the loan, it behaves just like any other 30-year fixed. I'll show you an example so you'll see exactly what it looks like. Because I think examples where people can actually see the numbers helps cement it. And so that specific 1-0 buy down is something I'm seeing a lot of buyers choose when given a bunch of different loan structures, when we're talking through, here's an option, there's an option, and then also talking with the real estate agent on what's available. With these buy downs, while you can fund it on the buy side, more often than not, it's funded by the seller. And I think sometimes if it's going to be buyer funded, it doesn't make as much sense as if the seller is going to pay it. Here's the thing. Q4 of 2023, we could ask the seller for a bunch of credit. We can ask them for $10,000, $15,000. I had credits up to $75,000 from the seller. Literally did a 3-2-1 buy down, which means we started 3% lower, then 2%, then 1%, and then years 4 through 30 was the fixed rate portion after those temporary rate buy downs on a $1.175 million purchase, something to that degree, right? So it funded that whole buy down where this person had a 2.99% in their first year. Now, 2024, little inventory, buyer demand that has come up since interest rates have come down makes it to where sellers aren't willing, able, or they don't have to give as much seller credit. So a 1-0 buy down requires the least amount of all these different buy down options. You can still get that from a lot of sellers in a lot of cases. And like I'll show you, it's only going to take a $3,600 credit, $4,000 credit from the seller. You can write into the offer where the seller still nets the same, but it allows you to structure a mortgage that for a lot of people makes sense. So enough talk. You guys want to see it, right? I'm going to show it to you. We're going to talk through it. So here is what a 1-0 buy down looks like. I also want to mention that I've got a lending partner that has graciously offered a free appraisal for anybody doing a 1-0 buy down through the end of March. So if you're doing a buy down through the end of March, and who knows, me and my team might honor this through April or May if we're feeling generous. greatmortgagebroker.com. It's how you connect me and the team. In year 1, you're going to have 5.497. This is a $550 purchase, 15% down. And in this case, it's only going to take about $3,600 in seller credit. Easy to ask for, right? If they were asking $550,000, maybe it's a, house that was listed at $540. And you come in, you say, we'll offer you $550 with $4,000 in seller credit. depending on how competitive it is, you might have to go that high or even higher. But the seller credit of $4,000 isn't a huge ask, right? It's less than 1% in this case. And so by doing that, you're able to start in years one, payments 1 through 12, with a payment that is $33.49 a month. If you just went straight into the 6.497 rate, your payment is exactly $300 more, right? So it's $36.49 a month. And I've got this fancy buy down calculator, right, where you put in the loan amount and the purchase price and the interest rate, and it shows you exactly what the buy down is going to cost, which in this case is $3605.64. What I often advise in these scenarios is ask the seller for $4,000. $3605.64 goes towards this buy down and funds this buy down for you. And then the other $394.36 goes to offset closing cost, offset prepaying property taxes and homeowners insurance and escrow fees and all the other things that go into it. So here it is again. And it's something that, in my opinion, is not only a good option for buyers, but it's one of the few options you have because of the market we're in, because of the fact that you can't ask a seller for $10,000, $15,000, $20,000 in credit, the amount that would be needed for a 2-1 buy down or a 3-2-1 buy down. Another thing to keep in mind, I've had this conversation recently. Talking to most people, we see mortgage interest rates going down over the next 12 months, 24 months. Not super fast, not super dramatic to where we're going to see a 5% interest rate in 2024. Probably not the case, right? So with that in mind, if you structure a loan in this way, where you've got a 5.497 in months 1 through 12, let's say you close a loan in February of 2024, your first payment is April. So you're going to make April of 24 through March of 25, this lowered payment. By then, we might have interest rates that are 5.75 or 5.5 or 5.25. Maybe, maybe not. Maybe it increases next April to 6.497, and it's still not the time to refinance. But come summer or fall of 25, you're in a position where a 5.5% or 5.25 doesn't cost you a lot of money. You refinance, you get back to that rate. Either way, you're not starting at 6.5, the higher payment, and you're not in it for long. Another conversation I have around some of these 3-2-1s and 2-1 buy downs is that might put you in a tricky spot. Imagine if you did a 2-1 buy down where it's 4.497, then 5.497, then 6.497. You might be in a weird scenario where you're 12 months into this thing and you're going to be in a 5.5% rate for another year. It makes the decision harder. I think 1 year discounted rate sometime in 2025, there's going to be a refinance opportunity available. The good news about these buy downs, if you're able to get more credit and you could do a 2-1 or something to that effect, whatever is remaining in that buy down account that's not used gets refunded to you as a principal reduction. So the money's not lost. You get it from the seller, you plug it into this account that's basically subsidized your payment for the first year or however many years of a buy down you've received. Either way, great product. We're offering a free appraisal with it. If you want any more information, we're more than happy to help. GreatMortgageBroker.com. Hopefully this video was helpful. Until next time, we gonna see.